Thanks for joining us today on Market Call. I'm Morella Fernandez. David Burrows with us on the show. He's CEO and CIO at Barometer Capital Management. He'll take your questions on North American large caps. Here is how to reach us today. Call toll free 1-855-326-6266. You can send an email in as well. marketcall@bnnbloomberg.ca. David, good to see you.
Good to see you too, Morella.
We've seen investors rotating away from big tech lately, but NVIDIA's results, are you seeing money flow back as a result of that?
Look, they are the 800-pound gorilla, and everybody needs to see their numbers. And there's no question they've got just a wave of demand. The big question I think that some investors have is just how much investment is going to be required to build out all these data centers. And in many cases, there are companies that are building them that have traditionally been capital light, meaning they haven't had to invest a lot of capital to grow their cash flows. And the sums that are going to be invested are massive. And so the question is, based on the revenues and the earnings and the cash flow that they will generate from the AI inference, whether they can get a return on the investment that they're making. And I think there's a little bit of a wobble in the market here now where the question is, is the profitability going to be there? It's sort of on the come.
So are you keeping money in tech? Are you trimming it? What have you been doing on that front?
Well, for the folks that have watched over the last year, we've pretty steadily taken down our technology exposure. We're only about 8%, which is very light. We do own NVIDIA, and we do own Google. But there have been parts of the market over the last year that have really started to perform and give us an opportunity to diversify, and not just in the U.S. In fact, our U.S. weighting would probably be as low as it's been in 5 years. And our exposure to international markets much higher.
Okay.
So there's been opportunities, but the truth is, over the last number of weeks, and in fact, couple of months, the market has been narrowing in the U.S., meaning fewer and fewer stocks participating, and that's not generally a super healthy thing.
You mentioned you've been looking at international markets. Where have you been looking at, and what is the idea behind each market you're looking at?
Well, if you look at the sector weights of international markets, they're quite different than the S&P. So, 31% of the MSCI All World ex-US index is financials. And large banks are doing well everywhere in the world. When you've got low short-term rates and sticky high long-term rates, their opportunity to make a margin is pretty darn good. And global banks are very inexpensive. We talked about Santander over time on some of the interviews, and Santander trades at 9 times where Morgan Stanley is 16 times, and they got a great balance sheet and good growth rate. So there's been an opportunity to buy some lower valuation companies in sectors that are not as overowned, and giving us an opportunity. And so we're in Japan, we're in Latin America, we're invested in the EU. About 20% of our average portfolio now would be international ex-US, and it's been outperforming the US stock market for the last 18 months.
And are there new markets to you, or are these markets you have invested in the past?
Well, we could see a shift coming about 4 years ago. We spent 2 years preparing, and we launched a fund 2 years ago in December to be specifically international ex-US, because we all have lots of US exposure to begin with. And the fund has done very well. It's 40 growth companies, 40 value companies, and just the risk reward has been excellent.
Okay. We will leave it there right now. We will take a quick break. David Burrows, the CEO, CIO, Barometer Capital Management. He'll stick around to take your questions on North American large caps. Back in a moment. Welcome back to Market Call. Thanks for joining us. David Burrows with us on the show as a guest. We'll start with an email from Shirley. She says, hi, could I please get David's opinion on Equinox Gold? I do own it. Equinox Gold, is that something you've held before? Continue to hold it all, David?
No, we don't. We don't own Equinox. In fact, so about 6 or 7 weeks ago, we reduced our gold weight after what's been a wonderful rally, and I do think that we're in for a period of some consolidation. We do have some Kinross and some Agnico Eagle. Of course, they're the big 1,000-pound gorillas that are multi-mine and in geopolitically jurisdictions where we're comfortable with the risks. I think that we are in the very early stages of the long-term bull market. I just think the market's taking a bit of a breath here. If you look at past long-term bull markets in gold, they tend to move in 3 legs. And after the first big leg, you get a breath for a few months. I think that the intermediate and smaller gold companies will have lots of opportunity in the next leg higher. So Equinox is not one that we've spent tons of time on, but I do think that there's going to be consolidation, and I think there's going to be lots of opportunity for the growers.
Okay, let's move on then to our first caller. Ray's on the line. Oh, sorry, Ray's got an email here. Hello, can your guest comment on Adobe? Is this a good entry point for my first initial buy-in? Adobe, of course, has been struggling. David, I'm sure you know that. They have been trying to prove that there's room for its product despite the evolution of AI. Where do you stand on Adobe?
Well, look, so from my standpoint, we start with market, and we've seen, for instance, the NASDAQ 100 go from 87% of companies in uptrends in July to today about 36%. So breadth has been narrowing in the NASDAQ, which is one of the reasons we've been, reducing our stake. Second, if you look at the sector, the software sector has been relatively underperforming now for a couple of months and is trading, below key support levels. So that's a second strike. 70% return is being in the right neighborhood, and the sector is trading below the 200-day moving average. And then when you get down to the company level, I think that Adobe has some challenges. I know, for instance, in our case, we use some of the Adobe tools a whole lot less today in a world where, we can generate images using generative AI. So I think Adobe has an issue. I am not a believer in buying one of the weakest stocks in a weak sector.
Okay.
We would do the opposite. We're looking for sectors that are strong on a relative basis and look for the leading stocks within the group. So other folks may be sort of value focused that way. We're never going to try and pick them off.
All right. I hope that is good for Ray. Let's move on to our first phone call today from Chris in Delta, BC. Hi, Chris.
Oh, hi, Morella. Thank you for taking my call. David, I'd love to get your opinion on natural gas right now. And your comments about picking a bottom are interesting because a lot of people are saying that we are in the final leg of this dance before a big move upward after this consolidating period for months now. And I'm wondering if ARC Resources is still a stock that you like. I believe you've recommended it in the past. And if it's not, where you'd be looking. Thank you both. Have a great day.
Okay, we're looking at the natural gas December outlook, which was 4.5, I believe. ARC Resources at 25.37 today, and down over the year. It's been sort of going sideways for a little while, David. And I'm pretty sure it was one you recommended in the past. Do you still hold ARC Resources?
Yeah, we don't hold it currently, but we do have actually a pretty significant energy weight. Our weighting is predominantly in oil. Our big holdings, I'll talk about one of them today. But we think that some of the long life reserve companies offer investors a couple of things. First of all, international investors are recognizing things may be getting a little bit more friendly here for investment in energy. Second, the companies that people invest in the U.S., the shale oil companies, obviously are having difficulty with their decline rates. And I think that the Canadian long-lived assets are starting to trade at a premium. because they don't have the same kind of decline rate, and they have very predictable long-term production. And then as an investor, these companies offer great opportunity for dividend growth because they've been paying down their debt and they've got lots of excess cash flow. So I think that natural gas will follow along seasonally. It tends to, but our focus has been more on oil. As far as ARC goes, it's a great company. It's well managed, but as the caller mentioned, the nat gas stocks have been in consolidation, have been consolidating for months, and at some point, if they start to break out, we'll start adding more. But right now, we're focusing on the oil producers. The truth is, the interesting divergence in energy is the fact these long life producers are behaving as well as they are, with oil behaving as poorly as it is. And that's generally a pretty good tell. You want to look in commodities for the areas where the stocks are behaving well, when maybe the commodity is a little less positive. It tells you what might be coming. So,
and you don't worry about oversupply in oil in 2026?
We like to take a cue from the market. And when the market is doing something that is different than what you might expect it to be doing, you should pay attention.
Okay.
So watching Imperial Oil march higher day after day, something's going on. And other companies like it, like Suncor and CNQ, performing really well. We'll talk about another name today.
Okay. Let's go to JP then. He's in Edmonton with a question. Hi, JP.
Hi, I know that you hold a lot in oil. My question was about uranium with Cameco. I know that after recently releasing earnings, their stock dipped a little. Just curious to your thoughts on them going forward. Thanks.
Okay, thank you for the question. David, Cameco.
Yeah, we think the outlook for uranium is really strong, as is the outlook for nuclear power. Obviously, assuming that we are going to get the build out that have been announced in data centers, the biggest constraint is going to be power production. If you're going to be in uranium, the granddaddy is Cameco, and so it certainly pulled back. It pulled back from a little over $150. It's $120 today. That has been representative of what's going on in the market. I think that it's trading around the 50-day. It's just below, but the long-term moving averages are sloped higher. And estimates are not going down, they're going up for earnings. So, it's traded better than just about 80% of the companies in the S&P over the last 52 weeks. And we think we're in a relatively early stage commodity bull market. So I'd be a buyer of the stock.
Okay, good to know. We're going to take another quick break. We'll be back with David Burrows, CEO, CIO, Barometer Capital Management. He's taking your questions today on North American large caps. Back in a moment. Welcome back. We have David Burrows with us today, and he's taking your questions on North American large caps. Let's go to Dennis. He's in Victoria with his question today. Hi, Dennis.
Hi, David. Wondering about your opinion on Costco Wholesale. This one's had a very big run for about the last 5 years, but it's off its top and seems to be falling slowly. Wondering what your opinion is on buying and what you think would be a good level. Thank you.
Okay, thank you for the question, David. We know we had Walmart report earlier today. They beat estimates and raised their guidance for the end of the year. I put Costco in that same sort of retail space. What are your thoughts on Costco?
Yeah, so, going back to sort of process, if we start with the sector, we have right now virtually a 0% weight in the consumer. And that's been because, across all of the consumer groups, starting with home builders, through retailers, through restaurants, through leisure, travel, airlines, all of them are performing poorly. So Walmart is a standout within the retail group, but Costco is not. We owned Costco for years. We came out of it early part of this year. The other big position we've had for a number of years is Dollarama, and we did come out of it. Frankly, it's doing better than I expected. It's basically right back to highs, so we got shaken out of that one. But Costco has been just leaking like a balloon. It's trading below all the moving averages. And until I see some better breadth in the consumer sector, I don't think I'd be putting any money to work there. You know, we have a data that's been coming in on employment, which is not overly rosy. And the housing market is weak, and the housing market has helped fuel consumer spending over the last number of years. So that factor is coming off the table. I would just be careful with the consumer right now.
Okay, good to know. Let's go to John then. He's in Kingston, Ontario with a question today. Hi, John.
Hi there. Thank you for taking my call. You're one of my favorite analysts on the show. You're very thorough in your analysis, and I'm sure your clients appreciate that. My question is on CNQ. Over the last 3 months, it's been moving up steadily, like most of the oil stocks, and I've learned over the years that oil stocks move before the commodity. And I think the IEA just came out with a report that we will not reach peak oil till 2050 or something like that, and OPEC is near capacity. So I could only see oil going up considerably over the next many years. Are you positive on CNQ, and would you buy it at this price? Thank you.
Okay, thank you for the question. CNQ, David, as you know, down a little sideways for quite some time. The price of oil hanging around $60-ish. What is your take on CNQ?
You know, look, CNQ is at $35 in March. It's trading at $48 today. It looks just fine technically. All of the moving averages have hooked higher. It's taken out the 3 most recent highs. And in the cohort, Imperial and Suncor are also behaving well, frankly, Cenovus as well. So, you know, historically, in a commodity bull market, you get gold moves first, the metals move second, and energy moves third. And I would say if you look at the XEG, which is the ETF for Canadian energy, it's just broken out of a big range. So look, what's wrong with a 4% dividend that's going to grow at probably 20% plus a year for the next 5 years? Pretty darn attractive, I think, and it's a great inflation hedge.
Okay, hope that is good for John. Let's go to Elliot. He's in Hamilton, Ontario with a question. Hi, Elliot.
Good afternoon. It's definitely not NVIDIA. Its recent quarter was a little soft, and Waste Management slipped down $45, but it seems to be moving its way back north. How would you read the fundamentals and technicals for WM, and would you start a position today around 216? Thank you.
Okay, Waste Management on the New York Stock Exchange. Is this a firm you know pretty well?
Yeah, look, you know, and I track the group of waste companies. And, you know, the only difficulty is the technical picture right now for Waste Management. You know, it broke the 200-day moving average around $220. And it has had a bounce from 200 up to 215, but it's trading below a declining 200-week moving average. And I'm not smart enough to outsmart the market. So I think that I would not put a new position on here. I think that there's risk right now in the market, in the U.S. stock market. And so long as breadth is narrowing, the first question should we be putting on new positions? And for us, that means no. So we really are not putting on new positions in the U.S. market. We're carrying between 15 and 25% cash in portfolios right now, which is certainly a shift from the last couple of years. And so the only thing I would be looking at is building a farm team, things I'd like to own. And then what I'm looking for there is what is it that's bucking the trend in the market? What is it that, despite all these worries, is performing better? And I can't say that about Waste Management.
Okay. Let's move on to another caller then. Colin is in Sarnia. He's got a question today. Hi, Colin.
Yeah, good afternoon, folks. Thanks for taking my question. It's about CEMEX. It looks like the U.S. is going to basically pour concrete over the entire nation with new industries flocking to the U.S. market. Is it in the right neighborhood? And I noticed that Amrise has an IPO which says that they're looking to make some extra coin through their financiers. So I'd like your opinion very much. Thank you.
Thank you for the question. Sure. CEMEX. Go ahead, David.
Okay, so first of all, let's start with breadth. breadth in Latin American markets is very good. So the percent of stocks in uptrends has been rising steadily. That's different than what we're seeing in the US market. Relative performance of the indices outperforming. If you look at the ILF, which is the ETF for Latin America, it's making higher highs and higher lows and trading above all the moving averages. And then if you look at CEMEX, CEMEX is trading better than 93% of companies in the S&P over the last 52 weeks. And it's trading virtually at a new high against, what we're seeing happening in some other sectors. So look, CEMEX is dominant in Mexico. If we think that Mexico and Canada probably ultimately win in a tariff situation because you'll have manufacturing get built out within the sort of North American bloc, we think that CEMEX could be a beneficiary. So I'd buy the stock here.
Okay, good to know. We do have to leave this block right now. We're going to do a quick break. When we come back, I'll look at David's past picks. That's coming up next. Time now for a look at past picks from David Burrows. These are from November 6th of 2024, so just over a year ago. David, at the time, he chose M&T Bank, MTB, on the New York Stock Exchange. It was $216.56 US at the time, down to $185.48 US today, so a 14% drop in return, a total return drop of 12%. This is a bank holding company headquartered in Buffalo, I see. What's been going on with them? Do you still hold a position?
Yeah, no, we don't. In fact, we don't own any regional banks. The regional banks over the last 6 months or so really started to underperform, partly, I think, because of the weakness in the commercial real estate market. And because there are some companies in regional markets that are funded that are getting hurt by tariffs. So when you look at financials a year ago, property and casualty companies were rocking. The regional banks were performing really, really well. The card companies were performing well. The big banks were performing well. The capital markets banks, the whole group. If you look at it today, really it's just the big banks within financials that are performing well. So that's really where our focus is. We use stops on every position we own. And sometimes you own a position for 2 or 3 years, and sometimes it winds up being, for a more shorter period because the market starts to fail. So we would be cautious right now on regional banks. In fact, in one of our portfolios, we're short the regional bank ETF. And that's because we think there are some credit issues out there in the market. Okay.
Let's move on to your second past pick from November last year, Motorola Solutions, MSI on the New York Stock Exchange. At the time, it was $469.13 US, down to $370.99 US today. So 20% drop return, a 19% total return drop. They do sort of equipment. They provide telecommunications equipment, communications equipment, that kind of thing. Do you remember at the time what led you to pick Motorola as a top pick?
Yeah, there's two companies that sell gear into the police departments for cameras, on-body cameras, and recording incidents, and then generating AI summaries and reporting. So it's a productivity tool. That's what Motorola is today. And both Axon and Motorola had very, very good runs, but both of them have run into headwinds. And that is representative of what's happened in a lot of growth stocks. As long-term rates have stayed high multiple stocks are having a difficult time. And you can see it in the market today and in the last few weeks. If you own a high multiple growth stock and long-term rates stay higher than people expect, then when you discount the future cash flows back to the present, you have to use a higher discount rate. And so that's posed a difficulty for a lot of growth stocks, and which is why really mid-cap and smaller cap growth are having a harder time.
Okay, let's move on to your third pick from last year then. Atkins Realis Group, ATRL on the TSX. It was $69.61 last November. Today it's $88.53, 27% upside. Same for total return. Pretty well-known engineering firm that seems to be doing well with infrastructure plan out and build out. David, do you expect this to get better? Do you still hold it?
Yeah, we think that the infrastructure engineering companies are in a pretty good spot, especially if you're working on power generation, which of course AtkinsRéalis is. They've got a big business in nuclear, and we think that there's a very long runway there. Also, if engineering companies are working around mining engineering, we think that that's a pretty good place to be. So we've had a focus on those areas as well.
Would you buy in at the point where it's at today, which is 88.52?
Yep.
Still would. Okay, good to know. All right, we're going to take another quick break. We'll be back with David Burrows, CEO, CIO, Barometer Capital Management. He's taking your questions on North American large caps. We're back in a moment. Welcome back. We have John on the line in Milford, Ontario. He's got a question today for David Burrows. Hi, John. John, are you there? Hi, John. Okay, we may have lost John. I think his question today was about TD, which is doing some comeback after getting penalized in the U.S., currently at 114.37. Is there more room for growth here, David?
So we think that we are in a world where inflation is going to continue to surprise to the upside. So we need to own sectors and themes that benefit in that world. Many would say that from 1980 until 2020, 40 years, the power was in the hands of the borrower because long-term interest rates kept coming down in waves through each economic cycle. We went to almost zero. Very hard for the banks to make money when long-term rates are at zero. So since 2020, we've seen long-term interest rates tick higher and stay higher. When the Fed cut rates last September for the first time in 40 years, long-term rates went up. So that's a change in behavior. So the spreads the banks are making are getting better. Now, you could say now that since 2020, the power's in the hands of the lender. And loan demand is going up. And the banks are in a position to take advantage of it. So everywhere in the world, banks are doing well. So the backdrop for banks is really positive. Now, the Canadian banks are really high quality, and they've done a great job of growing their dividend, even through a difficult banking environment. So the thing we have to watch is mortgage delinquencies, which remains quite low. There's a lot of refinancings this year. But look at the way the Canadian banks are behaving in a world where the markets are actually a little sloppy. So I think that's a great tell. We have a little over 20% exposure to banks as a firm, which is big percent for us. And I think TD is trading very, very well. So I would be a buyer of Canadian banks here, and I think they're going to do exactly what you would hope. You're going to get a rising stream of income that helps offset a rising cost of living.
Okay, good to know. Let's get to our next caller. Alan is in Montreal with a question. Hi, Alan.
Hi there. Yeah, thank you for taking my call. I'd like to ask David's opinion. I'm looking for a Canadian ETF covering the broad Canadian market. Thank you again. I'll hang up and listen.
Okay, thank you for the question. David, do you have an ETF you could suggest here?
Okay, so with a little context there, let me take a crack and give you three ideas. The obvious one is just the XIU, which is the Canadian market. And the Canadian market is outperforming the U.S. market. It has been for 18 months. Who would have guessed at the beginning of the year that we'd get tariffs and get all this disruption, and the Canadian market would be whooping the return of the S&P? But it is. And when that happens, it generally goes on to work that way for 7, 8, 9 years at a time. So that's the first big picture, really important take. International markets, which include Canada, because the sectoral makeup is quite similar, both for international markets and the Canadian market, is in a great spot. So broad market Canada, probably a good spot. Lots of energy, lots of banking, some industrials, materials. All of those groups should participate in this market. If you want to get a little more granular, the ZEB is the equally weighted bank index. And that's a great way to participate. It's had rising relative strength versus the S&P since April of this year, and is in a very tight trading range, and which we like to see. It means there's lots of buyers under the surface, and it looks great. And then the third one I'd take a look at is XEG, and XEG is the oil and gas ETF, and XEG has just broken out to new highs, and in fact making a new high today. So the last time it made a high was in March of 2023. It went through a long downward consolidation and has hooked higher over the last 3 months. And I think that we're in the very early stages of a bull market in energy. So that one is going to be a little bit higher volatility, but is likely going to be a great risk reward. And that's probably a good 3-4 year hold.
Okay, Alan, I hope that gives you some things to consider. Let's go to Amin in Ottawa with a question. Hi, Amin. Amin, are you there? Okay. Looks like we may have lost that caller. I think the question here, David, was either Enbridge or Pembina if you had a choice.
Yeah, so I think actually both look kind of interesting. Enbridge came down and tested the 200-day moving average, just at the end of October. And it's been in a series of higher highs and higher lows. Enbridge is a really great capital allocator. They are going to have, opportunities to grow with some of the changes going on in the political views of pipelines. Pembina is a lot more specific, and frankly, looks pretty good as well. If I had to choose one for a main portfolio holding in transmission, it would be Enbridge.
Enbridge at this point. Okay. Let's move on. Sorry, we do have to take a quick break. We're going to be back with David Burrows, CEO, CIO, Barometer Capital Management. We're back in just a moment. Stay tuned. Welcome back to Market Call. We are going right to the phone lines. Paul's in Orangeville, Ontario. He has a question today for David Burrows. Hi, Paul.
Yes, Vermilion Energy. Since the last report, they started to go up, and some days it's down. Today's was up, now it's down again. What do you think about it?
Okay, thank you for the question. Does Vermilion Energy tend to be a little volatile, David?
Yeah, it is volatile. Look, when we look at a sector, let's start with the fact that in general, especially in energy, the stocks tend to act a bit like a school of fish. They move together, but there's stronger ones and there's weaker ones. When we are building a position in a new sector, we start with the strongest company we can find, because you have to assume it's possible that conditions can get more difficult. And you want to own the one with the best balance sheet, the best income statement, the best growth opportunity, the longest life reserves. Because effectively, when you buy an energy company, you're buying an option. That is, how much have you got in the ground? And when you do get a bull market in the commodity, how much will people pay for it? So in the case of Vermilion has been one of the weaker performing stocks in the group. It's about 65% oil. And it is turned higher because energy has turned higher. But remember that in the case of Vermilion, for instance, the stock has been selling off since $35, back in September of 2022. It's $9. So technically, think about this. Anybody who bought it between August of 22 and recently, most people are underwater. So when you're underwater on a position, one of the things you think about is, well, if only it gets back to my price so I can get out and get whole. So you've got a lot of built-in sellers. Whereas on the other hand, if you look at like an Imperial Oil, and I know that this is not, for the speculator, because it's a big liquid, slow-moving ship, but every stakeholder is happy. It's trading at new all-time highs. So let's assume that things go well in energy. We want to participate for sure. But if things for some reason are worse than we expected, you've got to plan for that contingency. And I would rather own the highest quality securities, the ones that technically are sound, but fundamentally look great, because, there's risk and reward when it comes to investing.
Okay. Let's move on then to Wade, who is in Ottawa with a question. Hi, Wade.
Hello.
Go ahead.
Yes, thanks for taking my call. I'm calling concerning Next Gen Energy. With the VIX climbing and a permit pending, what would David's opinion be about starting a position at these prices?
Okay, Next Gen's at 1088. David, it's up 6.3% on the day, but down 8% over the year.
Yeah. Look, Next Gen is probably one of the highest quality development opportunities there is in uranium. It's in a geopolitically friendly place, Saskatchewan, and this is going to go forward. I think the biggest question is going to be who's ultimately going to step up and buy it. It broke the highs back in September. It traded through about 1250, which was a high from November of 23 and I think around April of 22. So that's a nice breakout. It's pulled back to test that breakout point. I think that probably it's a pretty good entry. Your risk is the market. My guess is the Canadian market's going to continue to outperform. So I'm more likely to put on positions here and understand that there's risk because it's a development company. But I think probably long term this is going a lot higher.
Okay, that was for Wade. He was in Ottawa. Let's go to Cajun in Toronto with a question. Hi, Cajun. Cajun, are you there? Okay, we seem to be losing our callers today, but he had a question about Celestica. We'll pull up the Celestica line chart and have a look at where they are today. They are down today 6.7%, but up 230%, 38% over the year. Is there still room for growth for Celestica, David?
Yeah, look, so Celestica is a long position for us. We've owned it, and it's been a great holding. It is in the neighborhood of the big data centers because they're contract manufacturers supplying into the into the data center development. So if there's risk to data centers, there's risk to Celestica. I have to tell you, I don't like the way that the Nasdaq opened at up about 2.4% early in the morning and reversed and is now down on the day. That's not a great technical sign. So I own Celestica. It's trading above the 50-day. That's great. We're going to keep it on a pretty tight leash because I really don't like the way that tech is behaving here. As I mentioned, we're underweight. So we own it. And would I buy it today? I don't think I'd buy any tech today. But if tech can find a way to hold on and reverse higher, take a look at it. I don't mean to sound wishy-washy, but you got to take into account short-term data and long-term data. They're winning in their marketplace. Technically, I think that there's some challenges on this AI trade right now.
Okay. Let's get into an email here from Ted. He says, could I please get the guest's opinion on TMX Group? So TMX Group are running, of course, the TSX, but also into sort of data and getting buyer for data. So is this a company that you like? Have you invested in the TMX Group?
We owned TMX and I used it as a top pick many times over the last 3 years. We came out of the position in August of this past year. And technically it broke. So now it's trading around the 200-day moving average. Most of the exchange companies have been a little weaker recently. So as I mentioned, in financials, and TMX fits into the financials group, I would focus on where the strength is, and that would be the large banks. I'd let a little water pass under the bridge here. We do like TMX long term. It is a data play. The TSX is likely to have experience higher volumes. It's likely to have more financing taking place in both energy and materials. But again, we got a trickier market backdrop, so you just want to be very careful what you're adding right now.
Okay. So we will leave it there for phone calls and emails, but we will have a look at David's new top picks. He'll share those when we come back. Stay tuned. Join us tomorrow for Market Call. David Driscoll will be on the show. He's president CEO from Liberty International Investment Management. He'll take your questions on global stocks tomorrow. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from David Burrows. We will start with Tamarack Valley Energy, TVE, on the TSX. What do you like ahead for Tamarack Valley, David?
Our baseline on everything we look at, we want something that's good getting better. So strong to begin with, but where something's changing for the better, which can lead to a higher multiple. So Tamarack Valley, of course, is very focused in the Clearwater oil formation in Western Canada. 90% of its production is coming from this area, which is very low decline and high return heavy oil. They've been aggressively shifting new wells to water flood technology earlier in the life cycle than most in the industry. And that means that they're able to support pressure and have better recovery of their oil. So this is a rare company that's paying down debt and increasing shareholder returns. So we think that they can grow production 5 to 10% a year over the next several years, easily financed with their cash flow. They're using about 60% of their free cash flow to pay down debt, which is getting down close to zero. And the rest is being paid out in dividends. So this is a dividend that's going to grow around 20% a year over the next 3 to 4 years. They're very close to debt free, and that's very shareholder friendly. If you can get visible growth and falling leverage and rising shareholder returns, what more do you want? But we think that this is going to be an ongoing winner and has an edge in the industry.
Okay, let's get to your next topic then, which is GE Aerospace, GE on the New York Stock Exchange. What do you like about GE specifically in this space?
So we talked a lot over the last 3 years about the aerospace and the defense sector as one that, has very good backlogs and the ability for companies to raise price if the cost of goods goes up. In the case of GE Aerospace, they really dominate the jet engine business. So when they split apart GE Aerospace is the commercial jet engine business. So they have over 60% of the wide body plane engine market. And that's a growing market. So two things. First of all, they have new generation engines, which are getting new announcements by airlines almost every week. Just recently, Emirates and Saudi have placed, major new orders for their new planes that they're buying, the 777s. So great, new engine sales in that. They've got a big backlog there. It's about a $140 billion backlog, and it's growing roughly 30% a year. But services, which is 55% of revenue, is 85% of profit. And so as they sell more engines, they secure long-term service contracts to service these engines. So airlines don't have much choice. Rolls-Royce is the competitor. Rolls-Royce has had some difficulty with their engines. And so, GE really is the only game in town. We get very good visibility on future cash flow. And we think this is a good thing in a market where there are some uncertainties.
Okay, that is GE for the aerospace part of its business. Let's get to your last topic, which is cash, essentially. I know you said you've seen some concerning things in the market, and so you've decided, I guess, to put some cash aside. Can you expand on your reasoning here?
Sure. So very simply, in our process, when breadth starts to weaken, we stop putting money to work. Because when breadth is expanding, there's no bear market in history took place while breadth was expanding. That doesn't exist. Most weak markets start with breadth deteriorating. In other words, fewer and fewer stocks behaving constructively on a technical basis. And that's been happening. So when that happens, we raise a little bit of cash, 7 or 8%. And then if we get stopped out of positions, the cash goes to the sideline. To be clear, cash is a terrible thing to hold for any length of time, especially in a world where governments around the world are printing money. But it does present opportunity when you get into a sloppy market. And when you go through a correction in a market, the market's like a great sorting hat. You know, the weak companies, they get hit. And the strongest companies, when people are looking at their holding, what would I sell? If there's consensus on something not getting impacted, they're probably doing something right. So when you go through a weaker period, the wind comes across the plain and blows away the sand and leaves the solid boulders exposed. So at some point, we'll start to see Brent improve. Who knows when that will be? It could be short term. It could be something longer term. I don't know. But when it does, we're going to have an opportunity to put some money to work. The second thing, of course, is if the market gets worse, we have less exposure. So sometimes I think the job of a money manager is to just go out and make investments. But I think the other job we have is to manage our clients' exposure. And we take that role pretty seriously. So I think it's a good thing to have a little cash right now.
All right. David Burrows, out of time, sir, but thank you for your time. Appreciate you joining us on the show. And thank you for watching Market Call today. We'll see you back here again tomorrow.